You've probably heard the cliche that every dollar you invest is time you don't have to work in the future. This is true. Money grows over time, and we can use this growth in order to support our lifestyles when we no longer have money coming in, typically during retirement. But people can be put off by investing. It can seem overly complicated, difficult, or just plain nonsensical. Many people feel as if the stock market is rigged. The S&P 500 has continuously been hitting record highs even despite lockdown measures and ongoing supply chain issues. This video is going to explain why you should invest in the stock market. It'll also alleviate potential concerns you might have from doing so, and it'll give you the framework you need even as a beginner to become rich over time. If you watch this video all the way through to the end, you'll have everything you need to know in order to set yourself on the path of becoming rich and wealthy. Now, if that sounds good, make sure to enrich the like button to increase this video's wealth in the YouTube algorithm. While you're down there, please also subscribe and ring the bell to be notified when new videos come out every Friday. They'll help you live a life you love through personal finance and self-improvement. Investing is the act of putting money aside today so that it will grow over time. This results in you simply having more money. This growth is often called the rate of return, which is expressed as a percentage in terms of growth per year. There are many different ways that you can invest your money. You can spend money on things to improve yourself, such as education, which can increase your earnings potential over time. You can invest in creating and running a business. You can invest in tangible assets and commodities like gold and art. And finally, you can invest in securities. This is typically what people mean when they talk about investments. Securities are tradable financial assets. This is basically just anything that holds value and is traded in a financial context. This includes things like stocks, bonds, ETFs, and mutual funds. Different types of securities are generally going to have different levels of risk associated with them. For instance, you've probably heard that stocks are a lot riskier than bonds. This is partially true. Stocks represent a piece of ownership in a company, whereas bonds are an obligation to repay some sort of a debt. In the case of bankruptcy, companies must pay off their credited debts first, and this includes bonds. So stockholders could essentially be left with worthless pieces of ownership of a company which is no longer in business. This extra risk isn't without its benefits, though, and that's because of a concept in finance called the risk-return or risk-reward relationship. This says that the riskier that something is, the more return it should bring you for assuming that additional risk. This is because for all intents and purposes, people can be considered to be risk averse, and this means that they don't want to assume additional risk without getting additional reward. For example, companies that issue bonds are given a credit rating. The lower their credit rating, which is an assessment of how likely they are to repay their debts, the higher interest rates they will need to offer in order to entice lenders to give them that money despite the higher risk. As an aside, this also applies to your credit rating, your credit score. The higher that yours is, the lower interest rates you're going to be able to pay on the debts that you owe. You can check out a cool video about that in the description below. Bonds have a historical average return of 5% a year. In contrast, stocks have an average annual yield of 10%. But are stocks twice as risky? In short, no. While they are more risky than bonds, stocks definitely are not the most risky thing that you can put your money into. Plus, there's things that you can do in order to mitigate your risk within the stock market. First, please do not come right out of the gate picking individual stocks. And this is where a lot of money is lost. I mean, just look at Wall Street bets. The same goes for options. These are essentially contracts which allow you to buy and sell stocks at a specific price in the future. Options are considered to be financial instruments, which is another type of security. Financial instruments, but not options, are going to be another way that you can mitigate your risk within the stock market. And that's because instruments are usually bundles or packages of different investments, like mutual funds and ETFs. These can increase the diversity of your investments and thus lower your risks. It's the opposite of putting all of your eggs in one basket. Mutual funds pool money from a bunch of different investors. That way they're able to afford more expensive investments. For example, a share of Google stock is worth nearly $3,000 right now. You and 29 friends can all put in $100 into a pool. Now you'll be able to collectively purchase a share, but you'll have to split the ownership of it between all 30 of you. That's what mutual funds do, but at a much larger scale. Mutual funds can either be actively or passively managed. When they're actively managed, fund managers come together and pick out individual stocks in an attempt to beat the stock market. And that means getting a higher rate of return compared to the benchmark. FYI, they're not great at it on average. Only about half of actively managed funds outpace their benchmark. Passively managed funds have a goal and then stick to it. That can be something as simple as tracking an index, again like the S&P 500. Because there's less decision making involved, passively managed funds are going to have lower fees associated with them. Mutual funds are priced at the end of market trading hours and thus can only be purchased before or after market closure. This isn't the case for ETFs. These are basically just mutual funds that can trade actively on the market at any time. ETFs will also generally have lower fees associated with them as compared to mutual funds. The most popular kinds of ETFs are index funds. These track an index like the S&P 500. Because I keep talking about it, the S&P 500 is a metric which is used to measure the performance of the US stock market. It goes up and down based on the weighted performance of the top 500 companies within the stock market. These companies are chosen based on their market capitalization, or essentially how valuable they are. The S&P 500 is actually made up of 505 different stocks, and that's because some companies offer multiple different kinds of shares. That and the math behind how they weight it is not important. What is important is going to be a real light bulb over the head moment. The Wall Street types can only beat the stock market less less than half of the time. But you are able to buy into the stock market itself by using index funds. This means that you'll be able to generate a higher rate of return than half of the active fund managers with just one simple investment. Now let's get into actually investing. First, you're going to want to use tax-advantaged investment accounts. These will give you special tax benefits that you won't be able to have if you used a typical investment account. Over time, this is going to save you a lot of money. First up is the 401k. This is an employer-sponsored plan which allows you to invest pre-tax money. You'll pay taxes on this money when you withdraw it in the future. This is especially good if you think your tax bracket is going to be lower in the future than it is now. One example would be if you have lower income in retirement than you do currently. However, most people expect to make more money over time. Even in retirement, we all want to be making more money, right? That's like the entire point of investing. However, it's still a good idea to contribute to your 401k if your employer offers it for two simple reasons. First, you can contribute up to $19,500 in 2021, going up to $20,500 in 2022, and this is money that would otherwise incur some sort of a tax liability for you. Second, your employer may offer a match. This is a benefit where they will also contribute to your 401k, typically up to some specified percentage of your paycheck. As someone who legally works as a contractor, I do not have access to a 401k or employer matching. However, I and everyone else in the US has access to the Roth IRA. This is another tax advantage account, but you contribute your post-tax dollars or your take-home pay. The contribution limit is also lower, up to $6,000 per year. However, you will pay no taxes on your investment gains so long as you withdraw that money after the age of 59 and a half. You're even able to withdraw funds earlier from your Roth IRA without penalty, so long as that's up to the value that you contributed to the account. The Roth IRA is great because your investments are going to grow tax-free. If your investments are going to be growing for a long time, that's going to save you a lot of money. To explain why, let's look at the concepts of the rule of 72 and the time value of money. With the rule of 72, you take 72 and divide it by the rate of return on the investment. This will tell you how long it's going to take to double your money. So 72 over 10% a year in the stock market says that you're going to double your money every 7.2 years. So the more periods of 7.2 years that you have your money invested, the more times it will double. This plays into the time value of money, which says that the secret to growing your money is simple: time and money. The longer your money has to grow and the more you have invested when you get started, the more money you'll have as compared to a lower rate of return or a lower starting investment amount. This is why it's so important to invest early and often. That way you'll have the most opportunity to seriously grow your money over time, and that's going to make you rich and wealthy. Plus, you'll be able to save even more money by investing within these tax advantage accounts. After maxing out your contributions to the 401k and your Roth IRA, that's when you should consider using a brokerage firm like one of the traditional companies or even something like Robinhood. Investments that you make on these platforms are going to be subject to capital gains taxes. That's what you're able to avoid by using those tax advantage accounts. Capital gains are a tax on the increase in the value of an investment from when you bought it to when you sold it. Tax advantage accounts, especially the Roth IRA, allow you to cash out investment profits and then use that money to live your lifestyle. And you'll be able to do that for little to no tax liability. Investing is accessible to everyone and pretty easy so long as you just don't follow the hype from online. Consult your employer about the 401k if you don't already have one, then make a Roth IRA online. I use Fidelity and enjoy it, but other popular options include Vanguard and Charles Schwab. Once you've got these set up, simply make your contributions, which you can even make automatically, and pick your investments. As mentioned, the best and simplest way to grow your money over time and beat the active fund managers is going to be to invest in broad market index funds. Also said earlier, here's why you should invest. It's less money that you have to earn later in life. There are basically two ways that you can make money: actively or passively. Active is basically just doing a job, whether that's traditional employment, running a small business, or doing some sort of a side hustle. Passively means making passive income, which is a hot topic and buzzword in finance content. Essentially, it's making an investment or doing something once that's going to make you money without having to do much at all. You can check out a cool video about that in the description. Every dollar you invest when you're 20 years old is going to be worth $442.59 in 40 years when you turn 60, assuming an annual 10% rate of return. This is money that you only had to do a little bit in order to earn, and it's done by simply investing in broad market index funds. Now, it should be noted that putting 100% of your money into the stock market alone is risky for two reasons. First, there's the opportunity cost of potentially missing out on a better investment. For example, some people recommend allocating up to 5% of your portfolio into cryptocurrency. Second, there's always the chance that the stock market crashes sometime when you need the money during retirement. The stock market is cyclical, and therefore it goes through its typical ups and downs. If there's a significant crash before you need that money, well, that could be pretty bad for you. The rule of thumb is that you'll be okay withdrawing up to 4 to 5% of your investment portfolio per year. That way, the value of your investments are going to grow faster than you're able to spend it. For instance, if you want to have an income of $60,000 per year, divide that number by 4% and you'll find out the value that you'll need to have in your investment portfolio in order to sustain that kind of income. In this case, it's $1.5 million. Make sure to sustain sustain that like button by clicking it if you learned something valuable. Also, make sure to subscribe and ring the bell to be notified if you'd like to know when new videos come out on every Friday. Click the video on screen to watch another that you're going to enjoy, and then please add some music, some stock market investments, or whatever else it is that you love to your day.